the four phases of accounting, and why do business keeps records. Accounting is a process, an art, and a service activity. Why? Is it important? And how can it be related to these four phases? But before everything else, allow me to introduce myself. I am Gaizami Carion, and on behalf of the Group 3 members, we will be learning and tackling about the four phases of accounting and the importance of keeping business records. So what is accounting? Accounting is a process, as it features a series of steps in order to lead to certain results. Accounting is an art because it requires skill and knowledge and observations to lead to a higher level of quality of results, and accounting is a service, as it's done as an activity or work for a certain purpose, provides financial information to different stakeholders. And as we go along to this topic, we will know why accounting definitions are relevant and important to these four phases. These four phases, so speaking of a phase is a stage, a period, or a step in series of events or actions to implement about. In other words, it is a process. And because the performance of these four phases may affect either in a positive or a negative way, these phases could not be executed properly without the proper skills, knowledge, and experience to provide quantitative information, which is useful in making informed judgments. So the first phase is recording. It is the basic phase of accounting that is also known as bookkeeping. In this phase, all financial transactions are recorded in a systematic way and in a chronological manner in the appropriate books. Its main task is to point out and record all financial transactions. The accountant goes over certain invoices, vouchers, entries, and other paperwork made by the accountant. When business performs transactions to other external or internal parts of the environment, accounting recorders are the documents and books involved in preparing financial statements. These records include assets, liabilities, ledgers, journals, and other supporting documents like invoices and checks. The most fundamental method of recording is the journal entry. It is a way of keeping economic and non-economic records, which is properly documented with a correct date, amounts to be debited or credited, description of the transaction, and a unique reference number. The second phase is classifying. It involves sorting and grouping similar items under the designated names, category, or account. Once the phase is done successfully for a given time period, the accountant will then be classifying these transactions. It is about identifying or separating accounts into different categories, like these accounts are real, personal, nominal, or is it asset, liabilities, incomes, expenses? This phase uses systematic analysis of recorded data in which all transactions are grouped in one place. This is necessary so that the rules of debit and credit can be correctly applied. The third phase is summarizing. It involves summarizing of data after each accounting period, such month, quarter, or even a year. The data must be presented in a manner which is easy to understand and can be used by both and external users of accounting statements. Graphs and other visual elements are often used to complement the text data. The main objective of this phase is to organize financial data in an organized and understandable manner. It is the process of putting the account balances in one place. A common example of this phase is the trial balance and the balance sheet. Other examples are income statements, statement of changes in owner's equity, among others.
In this phase, accountants translate their data into analysis which are suggested to the management. Interpreting phase of accounting is where the end users or the management decision makers analyzes and interpret the financial condition of the company after it was recorded, classified, and summarized. This is where they analyze and interpret how the company is doing and performing based on the financial statements and analysis reports given to them. This is where they determine the company's performance for some period. This also includes looking at indicators and comparing reports to previous months, years, or companies to evaluate how the company is performing as well as the profitability of business operations. This data is then used to prepare future plans and frame policies to execute financial plans. That is why keeping company records is critical, since it allows end users to make decisions based on last month's or last year's reports. And it is also easier for the accountants to track if there is something wrong with the performance or the financial condition of the business. Everyone in business must keep records. Good business records will help you do the following: monitor the progress of your business, project your tax liability, prepare your financial statements, identify source of receipt, keep track of deductible expenses, prepare your tax returns, and support items reported on tax return. Through these 4 phases of accounting, which are the recording, classifying, summarizing, and interpreting, business owners, managers, and other stakeholders can gain insights how the business is performing. And that will be all for the Group 3's report. Thank you for listening.